Good afternoon, everybody. Welcome to another FX Street webinar. My name is Sean Lee. My business is called FXWW, and I'm based in Sydney. And today I am going to do a talk on the market structure of the spot foreign exchange market. I hope everybody can hear me. I'll try and speak up a bit. I'm getting some messages that I'm too quiet. I've never heard that before. Now, I don't know quite what level everybody is at, so forgive me if some of this stuff sounds a bit basic, but I will try and give a general overview of exactly who plays in this market. So a couple of little housekeeping matters first. The usual disclaimer: this information in this webinar and on any subsequent PDFs are all for educational purposes only, and is in no way a solicitation to trade. I will provide a PDF on this subject. It will be available in the members section of my blog, where you can see the address here, and you can download that sometime in the next few days. Give me 3 or 4 days to get it done. You can there's my email address. You can also contact me directly if you wish. So, where should we start? The foreign exchange market is not obviously a physical market like an equities bursa or a futures market. It is created by a series of credit limits between banks. So you call them trading lines or credit limits or whatever you like, but it's basically an agreement between two banks that they will accept trades with each other up to, there could be very large amounts involved here. It could be $5 billion or whatever between Deutsche Bank and Citibank, that they agree to trade with each other up to that amount on any particular day. Now remember that in a spot market there are it's only the trade is, I can't even think of the word now, but it's 2 days out, the trade, so new limits are rolling off every day, if you know what I mean. So old trades are paid up, so one counterparty pays the US dollars and the other counterparty pays the euro, and then that credit line, whatever was used up for that particular trade, is freed up again. And it's very, very seldom, really back, back to the 1970s, really, before there, the last time there were any major problems with banks not being able to fulfill or live up to any of these trading agreements in the spot foreign exchange market. So, the big banks, and they all have credit lines with each other, and also the central banks would be involved in this. So if you take all the world's largest central banks, the Bank for International Settlements, which is the central bank of central banks, and all the big institutional banks and investment banks, they have trading lines and agreements with each other that they can do, they can trade up to a certain amount. So all of these counterparties come together in primarily an electronic broking market. It used to be all a physical broking market, and literally you had guys sitting on desks talking to, each guy might have been talking to 15 or 20 banks, and the banks would put in their bid and they would put in their offer as they saw it or as they felt fit, and this is how the market was initially created. And then other banks could deal on those prices or could tighten the spread as they saw fit. And that's what we see today in the electronic market. The biggest of the electronic brokers is called EBS, which you've probably heard of. And on this, all of the big banks and even central banks will put their bids and their offers into the market. And that is how a trading market is created. So the big players, you may see here, I've listed the sovereigns at the top. The biggest player, without a doubt, when they decide to become active, is China. And they are probably the only player in the market who's capable of moving the market on their own. I've never really seen anybody do it before, but they have the capability. They're not as active recently as they were maybe a year or 2 years ago. Look, at this could be, I'm not sure why that is, policy decisions, don't know. But they are very active, as you can imagine. They've got massive reserves, and when they decide to, allocate those reserves or trade aggressively with those reserves, then they are going to move the market. They will place their interest generally in one of the electronic broking shops, or they will also deal directly on some of the big bank trading platforms. Now, I don't want to confuse matters too much here, but some of the banks, the big banks particularly, have almost become brokers in a way. If you look at Deutsche Bank and their Autobahn platform, now Deutsche Bank is the biggest player in the market, and their Autobahn platform is in essence a broking platform. So Deutsche have gone from being a bank almost to being a broker, and their customers and other banks can deal on this platform just like any other broker. So you would see the big players like China or the BIS or the Asian central banks and the sovereign wealth funds, Middle East, Russia. All of these sovereigns would be putting their bids and their offers onto a platform such as Autobahn or a platform such as EBS. That's how we can see from time to time who's doing what. And not every platform tells you exactly how much is being done, the size of the trade. EBS generally does. You can see the amount that's actually on the bid. You can see that's 72 bid for 312 euros or whatever the case may be, and that can give you a very good indication as to the depth of the market. And some of the other platforms don't actually show you that information. Okay, so we've got the I've called them here the tier 1 and prime brokers. So there's one set of banks I've separated from the others. The names here are basically Deutsche, Citi, Barcap, UBS. These are the big bank players. They've all got their own platforms, and they are also prime brokers. Now, a prime broker, that's also like a credit line with normally between the bank and hedge funds, or it could be CTAs, or anybody who wants to trade in the market, wants direct access to the market. They sign a prime brokerage agreement with a bank. That allows the client to trade in the market under the bank's name. So it's not uncommon for Deutsche Bank to sell to Deutsche Bank in the market. Now, I exaggerate there a little bit in that there are filters, I think, on these platforms to ensure that doesn't happen, but it is actually quite possible that one client of Deutsche Bank is selling to another client of Deutsche Bank on an interbank trading platform, and they are both trading under Deutsche Bank's name. So if you hear some sites saying that big British clearer buying sterling, I mean that's actually nonsensical information, because it could be anybody. It could be me if I have a prime brokerage agreement with that particular bank. It could be me just buying on the bank's behalf. So to say that any of these big banks are in buying anymore is actually not quite true, because they have in essence become brokers, and the prime brokerage part of their business is by far and away the biggest part of their business. So the big banks, as I said, I'm calling them tier 1. They're also prime brokers. They have trading lines with all of the big hedge funds, who I'll come on to in a second, and they're very, very influential players. They do not, as in the past, try and move the market as much as they used to. They are quite happy to earn, large amounts of money as brokers, as clearing houses in essence, and allowing other entities to use their technology and their credit lines. So so that's the tier 1 prime brokerage bank, and then down to the next level, the tier 2. They're also significant players. The U.S. investment houses, Morgan Stanleys, etc. The Credit Suisses of the world, J.P. Morgan Chase, RBS, HSBC. I mean, all the names. These also, in part, have prime brokerage departments. They've got big, corporate clients. asset manager, bond market clients, but where they are not so big is in the actual platforms they own, if that makes sense. So they're the second level, and then you have the third level banks, who are basically everybody else, who of course have foreign exchange transactions to fulfill, but generally speaking, they just go into the market, and they're probably clients of tier 1 or tier 2 banks. So they're the banks at the center of the market. All of these tier 1, tier 2, tier 3, and sovereign names and banks have credit lines with each other. So generally speaking, for instance, two of the tier 3 banks may not, for whatever reason, have credit lines with each other. For instance, some countries will not allow their banks to have credit lines with other countries for political reasons. So if on a particular platform, it could be that that there's $50 million on the bid in euro-dollar, and one bank can only see 40 of those. In other words, he cannot sell the full 50. He can only sell 40 because he doesn't have an agreed credit line with the other 10. So that's basically how it works. We have these electronic platforms linked together, and the liquidity is created by the banks. Okay, so the world has changed a lot in the last, especially in the last 4 or 5 years, and since the global financial crisis. And previous to that, the banks were the ones who took the biggest risk, I would say, in the marketplace. You had two types of risk taker in the bank. You had the bank dealer, who sat at his desk, and this is what I was in my previous life. And I quoted prices to all comers all day, and I took on small or large amounts of intraday risk as I saw fit. And then you had the proprietary traders at the bank, who took at times huge risky positions using the bank's capital. That has changed. Obviously, since a lot of banks lost a lot of money during the crisis, and regulations have come in. Banks are not taking the same level of proprietary risk that they used to, and as I mentioned earlier, a lot of the banks have become more broking houses than risk takers, and they're not even taking the intraday risk anymore. They are just literally clearing business through and taking a sliver of a pip every time the business is done. So most of the speculation now is done by, and you see me mention here, the big speculative players. So let's look first at the hedge funds. There are surprisingly few dedicated foreign exchange hedge funds. I think the number of, say reasonably sized ones is probably around the 50 mark, which is surprisingly small. Now, there are also the big global macro funds. These are the monster guys with, $5 to $10 billion under management, and which is leveraged 10 to 20 times. So as you can imagine, these guys have got a lot of power, and they will at times take huge risk in the foreign exchange market. So the global macro means that you trade in futures, commodities, foreign exchange, roughly speaking. And sometimes if they see something in the foreign exchange market they particularly like, you'll see a lot of risk being taken in the FX market. Soros, for instance, was a global macro player. He played in all sorts of different markets, but his particular love was foreign exchange. And he oftentimes would put all his eggs into the foreign exchange basket, as we saw with the pound and the lira back in 1992 when he made his name and his fortune. So we have the global macro funds and the specialist foreign exchange funds. Now, big players, definitely, mostly medium-term type guys, position builders. They're not coming in and trying to move the market by 30 pips, to make a quick buck. Definitely not. They are, generally speaking, longer-term players. yeah, take huge positions and will sit on these positions for lengthy periods of time. So, you know, from time to time you may read that, you know, when I put out my, you know, professional positioning data, and you know, those positions can get skewed, can get, you know, seriously short one particular currency for you know, an extended period of time because they've got a large capacity. It's not unknown for one of the macro funds to have a $15 billion position, you know, so that's, you know, they're sizable and they will move the market once they start. And another thing to add is that they often speak to each other. So one guy gets super bullish dollar yen, don't be surprised if the other guys start getting super bullish as well. So they're the hedge funds. Moving on to the algos, completely the opposite. These guys are, they're in it for a quick buck. And a lot of these guys are similar to what I used to do. Interbank dealers who have a, they may have a system, some sort of a system in place. It could be a you know, technical analysis, or it could be just based on information they get. But generally speaking, they will have a system, and they try to move the market with size. You know, so they may have a trading line of, I don't know, I'm guessing a couple of $1 billion. And they will try and move the market in late New York when it's thin, try and move it 10 pips, take their profit and get out. So they're looking for irregularities or inconsistencies in the market, and yeah, that's what they do. So they, you know, a lot of the brokers and banks don't like them because they generally get hurt, but they nonetheless, I think, play an important part and add liquidity when oftentimes no other liquidity is available. It's the algos who add. CTAs, look, a CTA license, a commodity trading advisor, is the easiest and most straightforward you know, a license you can get in the market. A lot of people go and do it through the NFA. It costs you like $900 or something, and a couple of weeks study, and you get your CTA. So, and then hang your shingle up and call yourself a professional trader. So there are a few good ones. A lot of them are not all they're made out to be. And they raise money generally through retail type outlets, leverage this money highly, and then trade on very simple technical, generally, look, I'm generalizing here, but they generally trade on simple technical indicators. Look, they also add quite a bit of liquidity, so you know, we can't discount them completely. And then finally, we've got the high net worth individuals, which also, I guess, includes, you know, certain people in the retail market, but I'm more talking here about high net worths who trade directly with the banks. You know, there are some. You know, I know of one, a guy in Tokyo who turned over $2.5 billion last month. One individual turning over that type of volume. So, yeah, they're you know, they are an important part of the market as well. And these, all of these players get access to the market via the banks. Your tier one, I would say primarily tier one and tier two banks. They either have a prime brokerage arrangement, or they simply are a customer of that bank, and that's where they get their prices and their market access. The bigger the customer, of course, the more likely they are to have a prime brokerage arrangement, which frees them up pretty much to do to trade how they want. So that's the speculative players. As I said, they need to have an agreement with the bank to get access to the market. Then we're looking at real money. Now, a few broad definitions of this, but without going into it too deeply, real money is basically unleveraged, and it is funds that are actually moving from one center to another due to be they equity transactions or bond market transactions or the like. So the amounts can be huge. Definitely when you think about the bond market and the size of the bond market, the amount of money that changes hands, and that's why, especially here in Asia, we look closely at the Tokyo market, and even the investment funds when they have redemptions, or it can have a significant effect on the foreign exchange market. Again, these real money funds are more than likely customers of the bank. They don't need prime brokerage relationships, certainly not from a foreign exchange point of view. They're not no, I don't want to say they're not actual full-time professional foreign exchange traders. They just want to access the market. So they will generally deal with a salesperson at the bank who is advising them on when to enter and what are the right levels and this and that, and then these funds place their orders through the bank. Similarly, we've got the corporates. And look, you know as much about corporates probably as I do. You'll have a corporate sales guy in the bank speaking with them, with each treasury division in these big corporations, and they will have foreign exchange requirements. It may be mergers and acquisitions. They may be buying an overseas company, or they may be just importing and exporting. So they will have. As I said, foreign exchange transactions. Again, this is an actual real transaction. It's not leveraged, and the bank just simply puts that business straight through the market. And fixings, I'll just dwell on briefly here. They're rather than accessing the market directly, a corporate can often say to the bank, and whatever I will deal at. Whatever the fixing rate set today is. So they say, I need to buy $20 million against the yen today, but I don't want to leave you an order. I will just, whatever the fixing rate is set at, that's the rate I want to deal at. So the banks come together in this fixing environment, and based on the amount of bids and the amount of offers, they come to an agreement on what the fixing should actually be, and that is set that day, and the corporate gets that's the rate that he receives. Some corporates are obliged by their constitution to trade that way. And it's a little bit old-fashioned, but there are still some people who do it. So again, the real money and corporates are both. They're all unleveraged, and they deal basically as a customer of the bank. They go to the bank and tell them what they have to do, and the bank will place the offers on their behalf. And now this is information that, if you have the right contacts, is quite available. If you know, the best person to know actually is a really big hedge fund, because the big hedge fund, he's got all the banks ring him up and want his business. And it's generally the sales guy who rings him up. So the sales guy from the bank rings up the hedge fund and tells him every order he's got on his books, because he wants to try and impress him. So a little bit of a trick of the trade. By far and away, the best information is from the big hedge funds. But if your second cousin is working on a sales desk somewhere, give him a ring, and he'll probably be able to tell you where the the real money, particularly this real money in the corporate business, where's that situated. Okay, so moving on finally to the retail platforms, becoming an increasingly bigger part of the market. I believe it's now over 20% of daily turnover is by the retail platforms. So once again, a similar situation to what we just mentioned above. Each platform has an arrangement with probably a number of banks. So they will have a certain amount of capital. They will go and place that with the bank or the banks, and in return they get a trading line which allows them to trade up to that amount with the bank. Now then, the retail broker, he has customers. So just like all of us, I guess, we're all retail customers. We go to the broker and open up our bank account, our trading account, and in return he gives us a trading line. So it's just been, pardon the number of lines, but it's been passed down the line. So from one, the broker gets a trading line with the bank, and we get a trading line with the broker. Now there are two different types of retail platforms, which I mentioned here. Straight-through processing and non-straight-through processing. So straight-through simply means that every trade you do just washes straight through the broker. So the broking house has, let's say he's got arrangements with 5 brokers, and he gets their electronic pricing coming through all the time, 24/7, non-stop. and his software then takes the best bid and the best offer and creates a price. Obviously, he's in this to make a little bit of money, so he's going to put, half a pip on that price. Yeah, so either maybe half a pip either side of that price, and it creates his spread, which you are then able to deal on. So every time you make a trade, in theory, that transaction goes straight through to the bank at the other end. So all this particular broker is doing is a facilitator. He's allowing you access to the market, and he's taking a small fee for that access. A bit more controversially, and I may upset a few brokers here, but the non straight-through processing brokers, they keep all your business on their books. Well, most of it anyway. Sorry to upset people, but about 96%, or maybe even slightly more, of all retail accounts are going to blow up, are going to lose their money eventually. And the broker realizes this, and he says to himself, well, why should I clear this business if these guys are going to lose anyway? Now, this is, well, in my opinion, well, at the very least, slightly controversial, because it is in the broker's interest that you lose your money, and that's not a good situation to be in. But look at that's they can then offer you almost no spread at all, because the spread doesn't matter anymore. They're not trying to make money on the spread, and they're only trying to make money on you. They're trying to make money in essence on you losing your account, on you blowing up. So that's basically how the market is. The structure of the market. I don't know if I've left anything out. I should, just going back to the banks quite briefly. I should, speak a little bit more about the different types of dealers in the banks. So you have the spot dealer. As I said, he's become much less active than he once was, but nonetheless, because he's become much less active, because most of the transactions are electronic and just get washed, straight through the system. But nonetheless, he needs to sit there and make sure that, suddenly they're not $5 billion yen long and the market's collapsing 5 big figure because of something. So, he's got to obviously keep an eye on it all the time. But you've also then got options dealers and forward dealers. Forward dealers would have some small impact on the foreign exchange market, on the spot market, because of when they do their balancing. But look at it, it's doesn't really have any effect. But the options players, depending on, like recently where we've seen record low volatilities, option players have been fighting over every pip. And so they can be very, very active players. So you have, in a bank normally, you have a spot desk, options desk, forward desk, and then the sales desk. So the sales desk, they're dealing with the some of the the speculative players, like we just mentioned, the ones that are not, don't have prime brokerage agreements and aren't dealing directly. So the sales desk deals with them and with the real money players and with the corporates. The sales desk can have can be a very, very influential person if his customers really like the advice he's giving him, and he rings them all up in the morning and says, okay, well, I hate this Aussie, I think we should all be selling. It can if he's got some very big customers, he can have a short-term impact anyway. I don't know really what else to I know it's only half past. We're running a little bit early, but that pretty much sums up, what the market is made up of. So I think I'll just open it up for questions now. So anybody got any questions, they can start asking now, or writing even. Okay, I'm going to answer Ivan's questions first. So, hedge fund managers, and this is true, they've performed very poorly this year in the G10. I've even heard of one of the bigger currency managers who was boasting that he only was 1% down this year. Capital moving into trading emerging market currencies will continue. I think it's going to be difficult, Ivan. I think it's going to be very difficult, simply because of the structure of those markets. They don't want the hedge fund, especially Asia, they do not want the big hedge fund players coming in and playing. The equity markets are one thing, bond markets are another, but currency markets, we've seen this back in 1997 with the Asian currency crisis. So I think the regional central banks will do everything they can to stop the big hedge fund players coming in here and being speculating with their currencies. I think, that's what I would say. Anthony, retail clients, where would you suggest you get your order information from? Anthony, you get it from me, nobody else. That's all I have to say. I'll tell you whether I filter. I'm a trader. I don't believe everything I hear. I know there's a lot of people just want to be listened. They just want to. So it's so easy to say, oh, there's bids here and offers there. So who's gonna believe you? I don't believe everything I hear. I wait. I've been talking about it for days. Talk of this, the sovereign managers buying at 103.50 in the Aussie. I've heard the rumours for the last 2 or 3 days, but I haven't necessarily, I thought there was good chance it was true, but I didn't believe it until I saw it. And today I think we saw it. We've seen a nice bounce from that level. So now we believe the orders are there. The one thing is fairly obvious: our option barriers. It's generally easy to find out where they are. But if you want really good information on orders, ask me. Who's next? Mike, liquidity really low compared to previous years. Well, volatility certainly. I mean, the volatility that we've seen. I've never actually seen markets like this before, where the big players, and really we're talking here about, and I should have talked more about reserve managers, who, you've probably been reading about Russia in the last few days, who've been shifting their reserves out of dollars and into Aussie, for instance. Now, the Aussie's a relatively small currency, and for one of these big reserves to switch even 1% of their reserves out of dollars and into Aussie can have a very big effect. So the impact of this is, of course, that they kill volatility. So liquidity is actually overall probably quite high. So when you get to a liquid spot, there's almost unlimited liquidity. It's virtually unlimited. But then you can, from time to time you can have black holes. And the problem with this is, I think, that players like us, the speculators, we just give up. We take our ball and go home and say, I'm not going to play anymore because there's, the liquidity, we can't move the market. And that, so anyway, volatility is ridiculously low. I've never ever seen markets like this before. Money magnet. I think you're talking about stop losses here. Now I think I've put a PDF on the website as well. If you go to the member section on why dealers trigger stop losses. Look, it is hard to. The dealer will tell as soon as he is trying to trigger a stop, he will tell everybody that there are stop losses there, because then he is short. If he's trying to trigger a long stop below the figure, for instance, it's trading at 20. He goes short first, sells as much as he can, then he tells the world that there are huge stops below the figure, because then the market drives lower, triggers the stop, he's out of his short position, and he makes a lot of money. So I have to, you got to be, you got to sort of be careful about that sort of information. So anybody who's giving you information in the market, they have a reason for it. I think that's one thing to be, if it's going to hurt them, they're not going to give you any of that information. So as for clues to know when an order is coming in, no, I don't know. Not really. No. You just have to look for chart levels where you think stops would be likely to be positioned. That's what I would say. John Wayne, where do I think the Aussie is heading by the weekend? I hope it goes lower, John. I'm short. But I would think we are going to range trade. 103, I think I said that this morning. 103.5. If that holds, then I think we range trade probably. Back 103.5, 104.5. But the risk for me is still down. Now, so money magnets again. You're talking about technicals. Not when you're on a dealing desk. And when you're on a dealing desk intraday, especially if it's a bit of volatility in the market, you just don't have time to be looking at charts. You look at them in the morning. You know where the big levels are. You have a sense for where the stops might be, where the bids are likely to be, and the offers. And you store that away, and then you just start trading. So it's certainly not a case of poring over a chart and looking for indicators all the time. Far from it. I think that's more for a medium term, medium term traders than who can have time to check all the charts and the technicals. Mike, currency do I suggest for high volatility and good low trading cost? Oh, I'm looking for that one too, Mike, if you can find it. Look, I don't, things like I've stopped trading the CAD and the Kiwi and the ZAR and all these things. And the stocky, yeah, look, I don't trade it, but yeah, I believe it's, I believe it's a, pretty reasonable one to trade, but only during European hours. You can only trade it during Europe. You can't, there's no liquidity in Asia and none in, so, yeah. Would I trade it? No. Would I recommend you trade it? Probably not. Unless you really know what you're doing. James Brown asked, do I have a list of STP brokers? No, I don't. Sorry. But I think I think if you ask them, they're obliged to they're obliged to tell you whether they are. Look at that's me guessing. I honestly don't know. I think the price to pay with the STP broker is that his spreads are a little bit wider. And as I said, with a non-STP, he can almost give you choice prices. Choice means, the same bid, same offer. There's no spread. The non-STP, he can almost give you, choice prices because, as I said, unfortunately, he wants you to lose your money. Because then he gets, he keeps it. But look, the regulators are looking at this, so, there have been certain changes made, especially in the big centres. I think you'll find. In the big financial centres. Okay, so John, you're asking about a dealer. Sorry. Okay, I'm talking here about an interbank dealer, really. So when I'm talking about dealers, I'm talking about guys who are working in a bank, rather than brokers as such, retail brokers. I mean, they have people on desks, but they're mainly salespeople. They don't, they're either going to clear your business straight through, or they just ignore it and don't clear it at all. So that's the retail brokers. I think I should have made that clarification. The dealers I'm talking about here are definitely the interbank dealers. So have I missed any questions along the line? Yeah, look at it's a fair point. If you're working on orders, and I've said this to a few people before, so if you want to wait and enter the market when you think there's a big order, so you hear there are big bids at 103.50, you don't preempt that. You wait, and then see what happens when it gets there. It gets there, it stops there, and it forms an hourly base. Then you have a very good reason for going long. Now, does it go up? I don't know, but it's certainly a reasonable reason for, if you're bullish, for entering, for entering a long position. And there's a lot of people trade that way. A lot of, very successful people trade that way because the good thing is you have an automatic stop loss level. Once it goes back through there, you get out. So you literally, if you're quick enough, you can buy with a sort of a 20 or 30 point stop, and you could make 100 or 150 pip profit. pretty nice risk reward. You need a lot of discipline and patience, but yeah, it's certainly a very you know, it's a reasonable strategy. So, oh, CAD. Don't mention the CAD. Here we go. Herman. Look at it. I think the only reason it doesn't move is that nobody's got any interest in this time zone. It's a bit like this, you know, the stocky, like somebody was talking about, you know, the Swedish krona, which is called the stocky. During, you know, that moves during European time, and the Canada moves primarily during North American time, and that's when all the big flows come in. If I was a big speculative player and I wanted to do a lot of, you know, big, you know, transaction in the Canada, I would wait until all of the corporates and the real money players and all of those guys are active, which is during North American time. So it leaves itself open to triggering stops, of course, during this time zone, but the market's become clever in the last 20 years. It's learned its lesson, and the lesson is do not leave stop-loss orders in Asia, especially in Canada, because they will only get triggered. So I think you'll find a lot of the time that the market just cancel all their stop orders and just cancel all their orders and say just forget what Asia does. Okay, so Ivan's put something up there. Okay, money magnet. Yeah. Look, I've changed completely. I've got 100% turn. I don't want to drag this on too long, but when I left the bank, I started off as a interbank dealer, or I started off as an intraday dealer. And I look at it. To be honest, I did quite well. I think for about 2 years trading on my own, but I hardly slept. As a one-man operation, I was trading, all day, every day. It was just, it was crazy, and I just couldn't do it anymore. I was totally burned out. So I had to change from being an intraday jobber, if you like, to being a medium-term position builder. So I try to make my money on about 4 trades per year, I would say. And the rest of the time, it may seem like a waste of time, just making money and losing money, but only by doing that can I get a good feel for the market. And I never know which is going to be the next good trade. I just, you don't know in advance, and it's the one you least expect, and suddenly I get on something, it moves 10 big figures, and I make do well on that. So yeah, big difference. And the other thing, and I know some people talk about giving up trading and giving up their job and going trading full time. I find it much easier to trade well when I've got an alternative income. If I try to make money just by trading alone, I find that very difficult. So even with all my advantages, which I have a lot of advantages, I've got training and I've got contacts and information, and very difficult because the psychological aspect is just too harsh if for me anyway, if you're trying to just make money from trading. So I think that's going to about do it. No, Charles? Charles, I have no idea. They call it the loonie. Canada is called the loonie. And it just doesn't trade like anything else. I'm sure there are some people out there who think it trades really normally, but I don't. I just don't get it. I never have and never will. Is it untechnical? I don't know. Yeah. Sorry, Charles, can't explain that one. It's just loony. Trades like a drunk Aussie. There you go. Explains it perfectly. Yeah, well said. Okay, well, look, thanks for your time, everybody. Come back again. Once I'll think of another topic, and we'll do another one before Christmas. So, yeah, thanks very much for your time, and there will be a PDF on the website, hopefully by Sunday night, unless I'm behaving like a drunk Aussie, which I won't. So, thanks and good night.